So I'd like you to think back with me to the first time when that light bulb clicked in your head and value investing made sense. I'm sure some of you had an experience similar to my mentor and boss, Bob Robotti, who's here with us, who only knew value investing. It was what he was taught, and it just made sense. But I have a feeling that there are a number of you who maybe came across Warren Buffett's letters, maybe you read You Could Be a Stock Market Genius by Joel Greenblatt, or like for me, maybe it was reading The Intelligent Investor by Ben Graham, but all of a sudden you had this moment where everything clicked and value investing just made sense. When I was a student in business school, I had the honor of interviewing Jean-Marie Eviard, who was the manager of the First Eagle Fund. He was one of the original global value investors. And in the interview, he described value investing as being a big tent. And he said on one side, you have Graham and Dodd, who have a focus on statistically cheap stocks. On the other side, you have Warren Buffett, whose focus is more on looking for high quality stocks. And you have this whole space in between where many investors can apply the principles of value investing and tailor them in their own unique way. And many people have been successful in all of these different areas. One of the things I think that Ben Graham left us with was a framework to be able to stay in the chart I just showed. And I think that that framework can be summed up in 3 principles: that a stock is an actual fractional ownership of a business, that you must insist on a margin of safety, and that using the parable of Mr. Market, the market is there to serve you, not to cause you to act. And before Christian tells me to get stuff that everybody knows off the screen and focus on a stock, I'd just like to suggest that recently, it seems to me, looking back at this chart, that people, I wonder if everybody really knows it or if everybody really accepts that. And more, I find that people have shifted from the Graham and Dodd style over to the Warren Buffett style, which is fine, remains in that chart, but often sacrificing price versus value that they're getting. And I think that's an extremely important aspect. And I think that, as Seth Klarman says, there are sometimes good ideas that can be found somewhere in the middle of that chart, as long as you're always looking at the trade-off between price and value. What I'd like to do today is introduce you to one of our newest portfolio ideas. And as I do that, I hope to walk you through a couple of aspects of my process, and also talk about some of the attributes that we look for in common at Robotti Advisors. And then hopefully show you that by remaining faithful to the principles of Benjamin Graham, that sometimes you are able to uncover great opportunities somewhere in the middle of the tent. And the one thing that overarching at Robotti we always focus on is a behavioral advantage of focusing on the long term and operating all of our research activities in order to understand things that affect long-term earnings of a company. So the company that I want to introduce you to is Graftech International. Graftech is a leading manufacturer of graphite electrodes, which is a highly engineered, mission-critical industrial consumable. The company has a sustainable, low-cost competitive advantage from being vertically integrated into their primary raw material. They have a differentiated business model, able to, and just recently have introduced long-term take-or-pay contracts. And we think that with its durable low-cost competitive advantage, differentiated model, and a recent focus on operational improvements, Graftech's well-positioned to take advantage of an extremely favorable supply-demand dynamic that will allow it to generate significantly higher than average free cash flow for a period of time. Ticker symbol is EAF, sells for $12.79 with 279 million shares outstanding, $3.8 billion market cap, and a $5.9 billion enterprise value. And if you just look at trailing forward 1 and 2 year cash flow yields, 20, 23%, 26%, one indication of how cheap it is. So one of the questions I always ask myself early on in my process is, will I be able to understand this business? And will I be able to explain exactly how this business makes money to my daughter who's in 4th grade? So in order to do that, I think we need a 90-second overview of the steel manufacturing and process or industry. So there are two primary ways to manufacture steel. The first is the most common way, which integrated steel mills use, which is to use a blast oxygen furnace. Roughly 76% of steel is manufactured that way, but that's heavily skewed by the 96% of steel that's made that way in China. The second way is by using an electric arc furnace. The electric arc furnace has been a faster growing technology and is used in all of the mini mills. The electric arc furnace basically uses scrap metal as its raw material, whereas the blast oxygen furnace actually smelts iron ore and metallurgical coal as its raw material. A graphite electrode, which is what Graftech manufactures, is used to conduct electricity and generate enough heat to melt the scrap metal. The electrode is a critical input and there's no existing substitute. One of the reasons is the heat that's necessary to melt the scrap metal is so high, it's actually roughly half of the temperature of the Earth's core. EAF has also been growing faster because it's more resilient, has more variable cost structure, lower capital intensity, but most importantly, it's much more environmentally friendly, emitting roughly 25% of the CO2 that the blast arc furnaces do. So what does Graftech do? They manufacture high-quality, ultra-high-powered graphite electrodes. They operate 3 of the 5 highest capacity UHP electrode manufacturing facilities in the world. And after recent debottlenecking, starting in 2019, they'll have an operating production capacity of 202,000 metric tons. Their primary customer is the steel producers, which then sell into a multiple number of industries. Another important differentiation is there's 2 types of graphite electrodes that are used. There's high-power graphite electrodes that are used in the blast oxygen furnaces. Those are generally less technical and can be manufactured with lower quality materials because they're used to keep a liquid in a liquid state, as opposed to ultra high power electrodes, which need to achieve a significantly higher temperature because they're melting the scrap metal and keeping it at that state. In 2010, Graftech acquired Seacoke, which was one of their suppliers for a petroleum needle coke, which is one of the biggest and which is the most important raw material in manufacturing the electrodes. And they're now the only large electrode producer vertically integrated into their primary raw material. The needle coke that's manufactured by Seadrift covers roughly 65 to 70% of Graftech's needle coke requirements. And it gives them a durable, low-cost competitive advantage. In fact, we can see now needle coke prices have risen, but at the current time, Graftech's total production cost of an electrode using their needle coke is below the recent spot price of needle coke itself. So between 1984 and 2011, EAF production grew steadily at a 3.5% CAGR. By 2011, overproduction in China from blast arc furnaces caused overcapacity, and then a lot of that made its way into the export markets. As steel prices fell, electric arc furnace growth also declined, and so we went through a period of where Graftech faced some challenges. So Graftech faced challenges both in its electrode segment, as well as other segments that were non-core. By 2015, Brookfield came along and acquired the company. What they did in the process was they divested non-core assets, including the engineered solutions segment. They closed underperforming facilities and optimized high-capacity ones, such that the 3 facilities that they operate now actually produced more graphite electrodes than the 6 facilities they produced in 2012. And overall, they achieved roughly $100 million in annual cost savings. They currently also own roughly 79% of the outstanding shares. By 2016, the graphite electrode industry began to improve, and reversed and continued its upward trajectory. One of the things that did happen during the downturn, and what we find often happens in downturns, is the industry improved. And what was already a consolidated industry became more so, with 20% of production being taken out. Now, some of that has returned to the market, but what has returned is believed to be the end of whatever was not permanently shut down. Additionally, in 2017, the industry's third largest producer acquired the second largest producer. And so now we're left with 5 graphite electrode producers that produce the ultra-high powered electrodes, currently with an 84% share of global volume. The petroleum needle coke industry is also interesting, and it's also one that is pretty consolidated. The manufacturing they use for needle coke is similar to what a refinery does. And overall, global capacity is 750,000 metric tons. And that capacity has remained relatively stable for a very long time. It really hasn't changed for longer than 10 years. And historically, supply agreements with graphite electrode producers were negotiated on a 12-month basis. But recently, there's been a significant spike in needle coke prices. So the growth, or as the EF industry began to recover, that added demand for needle coke. But there's been a new source of capacity that has been really pressuring needle coke, and which is causing the price to rise to much higher than normal prices. And that new source is demand from the electric vehicle market. It's specifically used in the manufacturing of lithium-ion batteries. And we can see that in 2015, the quantity of needle coke used by the EV market was 1,000 metric tons. By 2017, it's already grown to 60,000 metric tons. And you can see in the chart on the bottom that that's expected to grow exponentially. Now, one caveat, this is often pointed to as one of the main drivers of why Graftech is a good investment. The one thing that's different from graphite electrodes and from the needle coke that's used in lithium batteries is that there are replacements available. They might not be as high quality, they might not allow for the length of driving distance, but there are replacements, and there's a lot of R&D being spent to continue to have those replacements improve to the level of petroleum needle coke. But that said, it's going to take time, and there will be pressure for some time on price. Now, because of Graftech's competitive advantage of being backward integrated into their primary raw material, one of the greatest changes that management and potentially Brookfield have made is that they levered their business and industry dynamics to introduce 3 to 5 year fixed cost, fixed volume, take or pay contracts. And because they're the only manufacturer that's vertically integrated, they're in a unique position to be the only manufacturer that can guarantee a reliable long-term supply of electrodes at a fixed price. And this is a very dynamic shift from an industry that is always operated on annually negotiated purchase orders that were non-contracted and non-binding. Whereas now, Graftech's shifting to a model where they're going to sell between 65 and 70% of their capacity on these long-term take-or-pay contracts. And the best thing about it is that it's working. So Graftech's going to limit the long-term take-or-pay contracts to the volume they can produce from drift needle coke, and they further hedge the largest input into needle coke, which is decant oil, to limit their experience, or really eliminate their raw material exposure. And you can see the average price of petroleum needle coke over the long term has been roughly $4,500. We'll talk in a minute about exact numbers, but you can see how high the next 5 years of take-or-pay contracts have risen to. And this is going to allow Graftech to generate significant amounts of cash. Now, one of the most important factors, I think a key investment factor when you have a company that's going to generate a huge amount of cash but doesn't necessarily have expansion opportunities, is what are they going to do with that cash? And this is where management and a shareholder with common interests comes into play. So Brookfield Asset Management their affiliates make up a majority of the board, and they have a long history of prudent capital allocation. In fact, another idea that we're invested in your board is another idea where they are majority holders, a similar dynamic, and we've seen just recently how they paid very large special dividends when the stock price was high, and recently exhausted their buyback for the year when the stock price was low. And already the company's returned cash to shareholders through special dividends, share repurchases, and they're beginning to pay down debt, $100 million this quarter, and that will probably continue for the next several quarters. So the question is, how do we go about thinking of how to value a company like this? And it's challenging because prices are elevated much higher than they have ever been. Will they stay that way? So when I think about a company like this that has some, there's some aspect in here, it's the contracted free cash flows. One way to think about it is to invert and think about what those free cash flows might be worth, and then see what the market is applying to the value of the rest of the business. Now we can see here that over the next 5 years, they have contracted, in the last years they have a bit more, but they've contracted 70% of their production volume at a weighted average of $9,700 per metric ton. Any way you look at that, discounted EBITDA, free cash flow, provides a significant margin of safety. The accumulated revenue that they'll generate between 2019 and 2022 is $5.2 billion. And with the Seadrift needle coke supplying all of the requirements, EBITDA margins will be greater than 70%. If you look at how that turns into free cash flow, you're looking at free cash flow roughly of $2.5 billion versus a company that has a $2.7 billion market cap right now. Now, two other very important questions to ask are, first, these are new contracts to the industry, the take or pay. Can customers just walk away from them? And that has happened in other industries that are cyclical. When the customer is doing bad and they say, okay, we'll pay it, but that's the last time we're buying from you, puts the manufacturer in a bad position. I would suggest there's several reasons that is unlikely to happen, certainly not at scale here. First of all, although electrodes are critical for EAF production, not having them, it means taking a steel production down, which could have tremendous repercussions. They actually just represent 2 to 5% of the total steel costs, which are probably not the place that is going to break a steel company should they come under financial pressure. Second, the take-or-pay contracts are contracted with a large number of customers, over 100, and they're all located all around the world, which should limit some of the risk. There's no provisions in them for renegotiation or price adjustments, and there's significant termination payments of 50 to 70% of the remaining contracted value. And one final thing, and I have a feeling this may have Brookfield's touch on it, is that all customers that enter take-or-pay contracts undergo financial and credit reviews, and less creditworthy ones are required to either have a parent company guarantee or offer some type of collateral to make sure they can follow through on their commitment. The second thing is China, the wild card. So there's two things from China that could happen. The first is, in 2011, they had a significant oversupply of BOF-produced steel. Could that happen again? And the second thing is, could they disrupt the graphite electrode market or the petroleum needle coke market from somewhere from the supply side? The fact is that since 2011, China has actually implemented plans to consolidate their steel industry, and a part of that plan is to close the blast arc furnace mills, which because of their other plan to increase the environment and help reduce CO2 emissions. So I think it's unlikely that the overproduction from BOF furnaces will continue. And in terms of the graphite electrode market and needle coke market, from the supply side, the electrodes that they manufacture now use pitch needle coke, which is much lower quality. In order to make petroleum needle coke would take them years. It would take years to build a plant in the US. It would take them much longer. So I think that's also a limited risk. From the demand side, will China create additional demand for UHP graphite electrodes? Interestingly, they have the lowest volume of electric arc furnace production, so they are an ideal candidate and have talked about expanding EAF production. In fact, there was a mandate by the government that 20% of production would be EAF by 2020. They're missing that miserably, but a recent 5-year plan that came out didn't give that number, but still talked about increasing EAF production. And so overall, risks of the thesis are declining graphite electrode spot prices, needle coke prices could continue to rise, which would reduce the margins in the 30% of sales that will be on the spot market. EAF production growth could slow or decline. Capacity additions from China. Operational disruptions from Seadrift, which have never happened to a major extent, but are possible. And large sale of Brookfield shares into the market. So overall, we think we have a company with a durable, low-cost competitive advantage that is currently in a unique industry supply-demand dynamic, where they have the ability to change the structure of the industry and generate significant amounts of free cash flow that are being overlooked by the market. That's all.
Thank you. Questions?
Thank you for the presentation. You know, one thing that I find fascinating here is that if you study the history of commodity businesses, a lot of the managers that run these businesses are used to only think of volume and cost. That's all they know, right? They've always been told, well, don't care about the price, and you have you cannot influence the price. This is a commodity business. And here you have an activist that comes in, right, Brookfield, and then they say, you know what? Let's just think about this for a minute, right? You have these management that, as you said, they have been running this business badly for so many years, right? In an industry that in theory was consolidated, and then this management, as an outsider, as an investor, very smart, Brookfield comes in and says, you know what? I think you're giving the product away, right? And so they do an auction. They say, okay, let the market, let the customers tell us what the price is. And so they do an auction, and as you know, very quickly, they realize that people are willing to pay, I don't know, $12,000 a ton for something that they were giving away for $2,500, right?
That's right.
And so they go, well, now we know. And so what are we going to do about it, right? And then they go, well, who can write contracts, right? Nobody. Only then can write contracts, right? Because the 2 Japanese companies are publicly traded, are naked on the needle coke. And so that's why they're writing 70%, right? Well, they're integrated because they have the visibility, right?
Right.
And so for me, what I find interesting is how in a commodity business, you can make a difference if you're a long-term investor. And I think this is a great example of, because many times in the U.S., activism is perceived as some sort of short-term momentum or whatever. And I think in this case, is the opposite, is changing the industry. But I have a question for you. And so when you look at the battery market, which is a completely new addressable market for them, right? Completely different than the electric furnace. As you put it in your charts, it could just be more than double, right? Or at the rate that it's going, who knows? But one thing I don't understand, I wonder if you guys have done work on this, is when you looked at the anode of the battery, right now the main theme is to substitute the natural graphite for synthetic graphite, which, as you know, increases the density of the battery, the range, the life, and the things that are in demand. So have you guys figured out if there is a technical substitution for that synthetic graphite?
From the work I've done, there is not yet, but there are products. One I've come across is graphene, has high promise to get there, and because of the explosive growth that appears to be coming in the EV market, there's a substantial amount of R&D going to figure that out. So that's why I said when you look at that chart that showed the lithium-ion battery market taking over the graphic needle coke market in 5 years, I don't necessarily, that would be wonderful, but that's not what I think is necessarily going to happen. I think probably we will find some type of substitute, and prices will be pressured for a while, but it's different than the graphite electrodes where there is no substitute, there's no substitute known or ever found.
Anybody else?
The PE now at 4 and all its competitors trade at these values, and you think about, you know, when Brookfield came in 2-3 years ago and practically couldn't give graphite electrodes away at the price, and you know they were closing capacity left, right, and center only 3-4 years ago. So I mean, your view is that this is not really a cyclical business; it's going to last a little bit longer than people expect. Is that what you do, or do you normalize the earnings? How do you normalize the current earnings?
So interesting. Maybe answered from two different perspectives. One, for this industry, I do think it's extraordinarily difficult because of the extreme, and that's why I think looking at it from a margin of safety, where I feel like you're getting the contracted business potentially at a discount, and certainly the rest of the business for nothing, is a better way to look at it. The second thing, I think two things. One, I think when Brookfield originally invested, they saw a company that had a durable competitive low cost advantage that was being run poorly, and that there were a lot of things they could fix, and they had entered a down cycle. And so what they did was take advantage of that down cycle when everyone else was freaking out. They got assets cheap, came in, improved the operations, and then ended up in a situation where needle coke prices began to rise significantly, and they had a blockbuster. But I think that their original, looking at it was the improvement they could make going into the recovery. At Robotti&Co, actually, we work a lot on cyclical companies, and often what we look for, it's interesting, when Bruce Greenwald talks about competitive advantages, I always, maybe this was just my perception, but I always thought of this company that has this walls up forever, and it's fortified, and that's the end of it. We're looking for companies that some dynamic has progressed, often in a downturn when the industry is consolidated, companies have shed assets, weak competitors have been absorbed by stronger competitors. And as a result of that, there is some period of time, multi-year, 3, 5, 8, 10 years, where maybe not a forever competitive advantage, but these companies will enjoy a competitive advantage and earn above average free cash flow. So when thinking about the free cash flow, normalized earnings, whatever you want to use, we're thinking about it in that period of time. Does that make sense? Or is that...
Yeah, I mean, it's a very difficult thing to do for a business like this, I grant you that. But I wondered if you looked at their competitors, most of the Japanese guys, Showa Denko, Tokai Carbon, the Indian guys, HEG and Graphite, and how would you compare EAF with regard to them, besides the fact that they've vertically integrated into coke?
I think that's if you asked 3 or 4 years ago, there wasn't, I don't know that there was much difference. I think that operations have improved significantly, but I do think that the real thing here is they have that competitive advantage from being vertically integrated. So, I mean, at the end of the day, the electrodes they produce are the same as the electrodes that the 3 other companies produce. They can do it better, cheaper, and that's what allows them to generate returns that are higher than the industry, or will allow them to.
Thanks.
Anybody else?
I think one of the things is in a commodity, when looking at how can you generate above average returns in a commodity business, the key is being the low cost competitor.
Okay. Second.
So you don't expect the high free cash flow to continue for a long time. When do you sell this?
I don't know about a long time.
Well, yeah, but it's not a forever story. When do you sell?
That's the. So I think you kind of have to keep looking at value going out 3 to 5 years and keep comparing that to price and try and understand when those fall more into balance. That is the one thing. We're never going to sell this at the high point, and that's always going to hurt in some way. But over the long term, buying in this and selling in this is what we're trying to do.
Okay. Thank you. Thank you so much, David.
Thank you.